Hi, this is Eric Boyce, CFA, CEO and Chief Investment Officer for BKA Wealth Consulting. Glad you joined us for our Economy in the Markets update for December 2019. We're going to have a lot of data and a lot of charts, and please feel free to contact us at the contact information you see below on your slide. If you have any questions, we'd be glad to help. Please see our disclaimer for relevant disclosures. Now for some summary points. The U.S. economic cycle has certainly passed its peak. Economic expansion is now in its 11th year, which is the longest in post-war history. Average annual growth during the cycle has been about 2.3%, which is the lowest of any post-war expansion. The economy does appear to have maintained moderate growth during the fourth quarter. GDP on an annualized basis grew 2.1% during the third quarter, which is down from 2.6% experienced over the first half of 2019. We do have the lowest unemployment rate in 50 years, and 3 interest rate cuts so far this year have lifted, amongst other things, the housing market. After-tax profits for businesses are down about 1.2% as of the third quarter versus plus 3.3% during the second quarter. Some of that had to do with some charges taken on the part of some very large and influential companies in the S&P 500. Recession fears have faded somewhat, but risks do remain on the margin. Consumer spending remains strong, up 3.2% annualized during the third quarter. Manufacturing does appear to have stabilized following a year-and-a-half long trade war. Fourth quarter economic growth is likely in the 1.5% to 2% range. Trade does remain the biggest risk to continued expansion, but we've had several positive pronouncements over the last several weeks, not the least of which being at least a phase 1 agreement in principle on the part of the U.S. and China, as well as some favorable trade news with regard to the revised, or I'll call it the new North American Free Trade Agreement coming out of Congress. Equity markets still remain dependent on earnings, which are forecast to be down year over year for the second straight quarter, whereas company balance sheets and credit quality still remain strong heading into the later stages of this cycle. As for GDP, we learned in the latest release of the third quarter GDP numbers coming out of the Commerce Department this past week that U.S. economic growth did nudge up in the third quarter, and there are signs that the economy has more or less maintained that moderate pace of expansion that we've witnessed so far in the year to date. Labor market remains strong, which is a big anchor for that. GDP increased at 2.1% on an annualized basis during the third quarter, and that was really unrevised from the prior estimate from November. Economy grew at a 2.0% pace from the April to June timeframe. The consumer spending was stronger than previously reported, and there were also upgrades to business spending on non-residential structures, such as power infrastructure, which did limit the drop in overall business investment. That offset downward revisions to investment in home building and inventory accumulation. And imports, which have been a drag on GDP growth, were a little bit higher than previously expected. After-tax profits without inventory evaluation and capital consumption adjustment were revised down to show them down about $23 billion, or a rate of 1.2%. Profits were previously reported to have been down about 11.3%. Some of those were in part due to large legal settlements. The economy appears to have maintained that moderate growth for the fourth quarter, as I mentioned, with the lowest unemployment rate in nearly half a century, supporting strong consumer spending. And as I mentioned, recession fears have really come down quite a bit. Growth estimates for the fourth quarter range from 1.5% to roughly about 2%. As far as the labor market goes, the unemployment rate returned to about a 50-year low. In November, that rate was 3.5%, and that was right at the level of September, which was that 52-year low spot. Employment to population ratio stayed at 61%, which was flat for the third consecutive month, whereas labor force participation ticked down slightly to about 63.2, which is fairly close to the expansion high recorded back in October. Looking at inflation, inflation continues to run below 2% on a fairly consistent basis. PCE, or personal consumption expenditures, is an indicator that the Federal Reserve looks at fairly closely in helping to determine its open market committee policies with regard to short-term interest rates. For October, the PCE price index rose 0.2% after being fairly unchanged during September. Meanwhile, the core PCE, which excludes food and energy prices, was up 0.1% after being essentially flat in September. The more volatile components, such as energy, were up 2.6% in October, but are down 4.2% year over year. Meanwhile, food prices were up very slightly at 0.2% and are up about 1% versus a year ago. Now, looking at the trend line index, or the 12-month change in the total PCE, that was really unchanged from the prior reading at plus 1.3%, while the 12-month change in the core index actually declines just slightly to a positive 1.6%. And both total and core PCE inflation remain softer than they were through most of 2018. And as I mentioned before, they do remain below the FOMC's 2% long-run goal. We've already talked about GDP a little bit, but just a couple of extra comments with regard to the growth rate. Real residential investment increased in the third quarter after 6 consecutive quarterly declines as the housing market improved and we experienced lower mortgage rates by virtue of the 3 rate cuts by the Federal Reserve this year, and more so the downshift in the 10-year Treasury rate. Real non-residential fixed investment fell during the third quarter, the second straight quarter that we've experienced that. Real personal consumption expenditures were up about almost 3% at an annual rate during the third quarter, and there was an upward revision to the inventory investment growth, which does contribute to the investment side of the GDP function. Even though we've seen a few little green shoots coming out of the manufacturing side, and at least sentiment beginning to settle out with the hope of some settlements along the trade front, there continues to be some sluggishness in manufacturing. At least in October, manufacturing production decreased 0.6% after decreasing 0.5% in September. The 12-month change as of the end of October, which is the last data point that we have, was a negative 1.5%. The ISM, for the Institute for Supply Management Manufacturing Index, actually decreased to 48.1% from 48.3 in the November reading. And anything, well, I should say that as a diffusion index, any reading below 50 represents contractionary levels. The supplier deliveries index was the only component within that ISM number that was actually above the break-even of 50. And meanwhile, the regional Federal Reserve surveys of business continue to point to some sluggish manufacturing growth in most districts through the November timeframe. Looking a little bit at the household sector, we'll first take a look at disposable income and consumption. Income growth was weaker than expected in October. Nominal income was flat, but real disposable income fell. This was really likely due to probably some temporary factors in the growth of wages and salaries, which actually continue to remain fairly strong. Nominal personal income was flat in October, and whereas disposable personal income fell 0.3% in real terms. Personal consumption expenditures grew fairly consistently, as they have all year. Real personal consumption expenditures were up slightly, about 0.1% in October, but they remain up almost 2.3% on a rolling 12-month basis. The personal savings rate, due to strong consumption, actually fell from just over 8%, 8.1%, to about 7.8%. And growth in goods consumption remains fairly strong, and services, which accounts for the majority of consumption, weakened a little bit year over year, but the overall number in consumption remains fairly strong. Looking a little bit more specifically at consumer confidence, consumer confidence has been a little bit more volatile as of late. I think owing to some degree the threat of trade tariffs on goods that would be more impactful directly to the consumer sector. This would be retail items coming out of China that would become more expensive. It has a little bit to do with that, perhaps a little bit to do with maybe some lingering recession fears, but I would say that consumer confidence has been fairly strong and was probably due for a little bit of a reset. Now we've got two different surveys here. We've got the Conference Board, and we also have the University of Michigan survey. And so if you look at both of those readings in November, the consumer confidence declined a little bit during the month, decreased to, at least in the Conference Board reading, to about 125.5 from just over 126 in October. We had a little bit of erosion in the present situations component, meaning that the comfort level that consumers have with regard to what's going on right now. And we had the respondents that are, that give feedback regarding their expectations, at least from a business standpoint. The fraction of those respondents that expected better business conditions over the next 6 months declined a little bit. Now looking at the Michigan survey, it was 96.8 in November, which is actually up from 95.5 in October. But if you look at the series, it's bounced up and down almost on a monthly basis. So it's really more important to look at the trend line data as opposed to any one monthly data point. Now switching to the business sector, we'll look at equipment investment and capacity utilization. Equipment spending, for the most part, fell during the third quarter. Real business equipment investment actually declined 3.8% on an annualized basis during the third quarter, and equipment spending fell at a 1% annual rate over the first 3 quarters of the year, compared with a 5% increase during 2008. Obviously, we've got two different things going on. 2008, we were coming off of the tax law changes, which had some incentives for businesses. 2019, we anniversaried those law changes, and some of the benefit naturally waned. And then we also had uncertainties related to trade that were impactful in that number. But in the third quarter, spending declined for information equipment, transportation, and rose a little bit for industrial equipment. We've had recent weak trends in economic investments, as we've talked about previously. We've had fairly low levels of manufacturing capacity utilization, which is another trend indicator that we watch. That number was, utilization was about just under 75% during September, which is data that comes at really a couple-month lag, and that's significantly below its long-run average. We've had a little bit more of a rebound in shipments of capital goods, dating back to the October reading. Shipments of non-defense capital goods, if you exclude aircraft, rose 0.8% in October after falling a little bit in September. And this number really represents kind of a proxy for overall equipment spending. If you look at orders of non-defense capital goods, excluding aircraft, again, the last number was shipments. Now orders actually were up 1.2% in October, following a modest drop in September. New orders are now pretty much roughly in line with shipments, suggesting perhaps some near-term neutral impacts for overall equipment spending, with perhaps some green shoots or maybe an increased optimism with regard to the potential for continued positive headlines in trade. As I mentioned at the outset, looking at housing, the 3 interest rate cuts by the Federal Reserve this year have really been a boon and a tailwind to housing. Single-family starts continue to improve. Housing starts in October were up by 3.8% after falling by almost 8% in September. Again, the data series has been a little bit more volatile, but the general trend has been positive. Single-family starts were up 2.0% in October, which represents the 5th consecutive monthly increase, and they're now up over 8% on a year-over-year basis. And with that, essentially that 100 basis point decline in mortgage interest rates, which is indirectly related to short-term interest rates, more so to 10-year Treasury yields, that decline is now boosting the single-family construction sector by a fair amount. And I would say that permits as well are also on an upward trend. Multifamily, which is much less impactful overall to the housing market, and these numbers are fairly volatile. We're up actually almost 9% in October. But that data series is much more volatile than the single family number is. Government spending in real terms was fairly strong in the third quarter. Over the 4 quarters that ended in September, real government consumption was up about 2.2%, which includes gross investment. Relative to the second quarter. Real federal spending was up about 3.7% during the year ended September, which is almost the strongest rate since we've seen since 2010. Spending on defense was up about 4.6%, whereas non-defense spending was still up by a fairly respectable 2.5%. We would probably expect federal spending to slow somewhat in the next several quarters. Real spending by state and local governments has been stronger, actually strengthening over the last couple of years. Rebound has been led by some investment spending, and we've also seen employment growth at both the state and local level, and that's continued to help drive overall positive trends in this data series. Now, continuing this look at government spending, we'll spend just a minute on state and local gross investment. At this level, we're really talking about employee salaries and other minor spending, but the growth of employment at the state and local level has continued to trend positive. Growth has remained fairly steady. As I mentioned in the previous slide, it looked like it's trending up slightly if you look at it over a trailing 4-quarter basis. And continued growth in state and local spending should continue to give us a window into some of the health at the local market level in terms of economic expansion over the next year. Now, switching to trade, we continue to see the trade deficit drop again in October, which is our last reading. The trade deficit declined to $47.2 billion at that reading, down from $51 billion in September. Meanwhile, both real exports and imports declined over the month, as they did in the previous month. Real goods exports were down 0.5% between September and October, which was really driven by lower export volumes of capital and consumer goods, excluding autos, as well as agricultural goods. Real exports of oil actually increased over the month. Non-oil goods imports dropped a fairly significant 2.3% in the last data reading as import volumes of both autos and consumer goods declined. Meanwhile, net exports subtracted about a tenth of a percentage point off of GDP as it continues to be somewhat of an anchor on growth, but again owing itself to trade concerns as well as the general decline in global trade over the last year or so. Now, as far as oil goes, prices really going back to June have remained fairly stable in that mid-50s level. We've had quite a bit of stability due to higher U.S. production, but this is being offset by lower supply coming out of the Middle East, notably Saudi Arabia and Iran, as well as another OPEC member, which is dealing with its own failed state issues, and that's Venezuela. Consumption overall, as it relates to oil prices, is expected to be roughly similar in 2019 relative to last year. Oil prices will probably continue to face some downside pressure over the next year with supply increases not only coming from the U.S. but also from Brazil as well as Norway. And inventories are apt potentially to rise without corresponding cuts announced by OPEC countries. And another footnote as it relates to data coming out of the Federal Reserve Bank of New York is that half of the global increase in 2019 demand has been from China. Now, looking at the labor market, really what you could say here is that labor remains fairly strong. We have fairly low unemployment. Again, we've mentioned it's down at a 50-year low in terms of unemployment claims, but payroll growth continues to exceed expectations. We've had strong increases in non-farm payrolls, and private payrolls have increased as well. Average weekly hours worked by private employees remain fairly steady at about 34, almost 34 and a half hours for the third consecutive month. Average weekly hours have fluctuated in a narrow range, but they remain positive as well as aggregate weekly hours worked by private employees, which were up 0.2% in November. Now, looking more specifically at average hourly earnings and the employment cost index, earnings growth continues to increase, at least as of the November reading. Average hourly earnings were up 0.25% in November, which is really on pace with the average growth rate in earnings during the balance of 2019. Average hourly earnings were up 3.1% on an annual basis during the month of November, which is slightly above the 2018 pace. The 12-month change in our average hourly earnings was a little bit below where it was this time last year, which was a very healthy 3.3%, but it's still fairly favorable. Average weekly earnings for private sector employees were up about 0.25% month over month from October through November, whereas on the more smooth 12-month change, average weekly earnings was up about 3.1%. As we mentioned before, inflation has been trending very, very low, unusually low, particularly for this point of the cycle. If you look at inflation over core goods and services, those numbers continue to move a little bit sideways. Core CPI was up 0.2% in November, which is the same rate as October. Core services prices were up 0.3% in November, which is slightly above the rate from the prior month. And if you look at rents, which is a component of that, it was fairly strong and probably had much to do with that monthly increase in the services prices. If you look at goods prices, they were flat in November, although That's actually a little bit higher on pace than the prior 2 months when it was flat. Now, looking at inflation expectations, which are really important to such areas as the mortgage market, as well as long-term capital budgeting decisions on the part of major companies, the medium-term inflation expectation number actually ticked up in the last reading. It went up from 2.4 to 2.5% in November. The 1 year ahead inflation expectation was a very small increase, but getting itself to 2.4%. And home price growth expectations continue to increase, and the expectation of home price increases was 3% in November, which reattained a level that we last saw in July. Now, switching to the financial markets, we first look at the U.S. equity market. As you can see on this chart, the index continues to attain new highs while volatility remains low. We've had continuing favorable capital flows within the equity markets. Volatility, as you can see, is still trending fairly low in the 15 range. And just by reference, this time last year when we were quite much more worried about where the pace of the equity market was going to take us, the volatility level as measured by VIX was around 25. Looking at the U.S. dollar, really since the beginning of the year, the dollar is depreciated ever so slightly against a basket of global currencies. But if you look against the euro and the yen, which are the two primary comparisons, between roughly the beginning of November and the first couple of weeks of December, the dollar appreciated almost a percentage point against the euro, and about 0.5% against the peso, and about 1/3% against the yen. But as I said, if you look at the year to date, the dollar is essentially flat against those basket of currencies. Now, looking at 10-year U.S. Treasuries, you can see that the intermediate term trend has been down with the change in interest rate policy on the part of the Fed towards the end of last year, as well as muted inflation expectations. You can see that downtrend has persisted up to just about several months ago, at which point longer term Treasury yields have increased slightly since early November. But you can continue to see that term premiums have been flat to negative over a multi-year period, and we expect low rates to continue based on, as I mentioned, the muted inflation expectations which we saw earlier in the slide deck, as well as some of the lack of transmission of employment cost indices into overall inflation numbers. On behalf of the team at BKA Wealth, I really appreciate you taking the time to spend with us as we review some of the key data and charts related to the economy. I'd like to offer a quick summary. Consumer spending was positive but moderated a little bit. Real business equipment spending declined a little bit in the third quarter. Growth rate continues to be a little bit below the pace of 2018, but there are some green shoots related to more optimism on trade. Housing activity indicators displayed further improvement based on trends in housing affordability as it relates to mortgage rates. Payroll growth remains robust and fairly solid year to date. Unemployment rate is down at a 50-year low. Labor force participation edged down a little bit, and employment to population ratio remains near its current cycle high. Inflation levels remain low and continue to run below the Federal Reserve's longer run objectives. And equity markets continue to rise, setting new records. Meanwhile, volatility remains fairly low. 10-year yields continue to be low, even though they might have ticked up a little bit recently. And expected interest rate policy shows continued flattening through the middle of next year. And what I mean by that is that the Federal Reserve is expected to more or less sit on its hands with regard to short-term interest rates for at least the next several months. But again, those are just some summary points. We appreciate you taking the time to visit with us on these important topics related to our economy. We certainly invite you to give us a call at 512-496-5709. Should you have any questions, you can see on this slide my contact information. I'd be happy to answer your questions. Have a great day and happy holidays.